Hey, what's up, everybody? This is Tim Hart, branch manager of VanDyk Mortgage in Fort Myers, here with my boy, my friend, my mentor. Love you, John Barnes. John Barnes, our secondary manager from VanDyk Mortgage. John, how you doing?
I'm good. How are you, Tim?
Doing good, man. You look sharp as ever, bro. I got to tell
Well, I had to dress up. You said I had to be on camera
you.
today.
Appreciate you showing up, man. And so, John, what we're going to talk about today for the viewers out there and the listeners is we want to do a little course on interest rates. Okay. So we're going to get into what goes into rates, causes them to go up or down, and then maybe the outlook on the rates moving forward. So first off, John, if you don't mind telling everyone out there, because I know you're one of the smartest guys in the world, but if you don't mind telling them, what is a secondary manager? What is your job at VanDyk Mortgage?
You oversell me a little bit here. Not the smartest guy in the world, but thank you very much. So I oversee secondary marketing and capital markets. When you hear the word markets, think like stock market, bonds, securities. Don't think like, hey, I'm sending you a postcard type marketing. Something a lot of people get thrown off as they hear secondary marketing. Is this like a second layer to you soliciting me? No. Secondary markets
You are
actually,
not spam.
no, I do not.
Right. I
Um,
do that.
Secondary marketing deals with Wall Street, and it's trading mortgages um, with the perspective that we need to maintain liquidity so we can fund the next loan. So there's two main markets in the mortgage industry. There's the primary market, Tim, that's your market. That's where loans are originated and closed. And then there's the secondary market. And that's going to be where last year we funded $1 billion worth of loans. We obviously don't have $1 billion in the bank. So in order to keep funding that next loan, we have to sell loans on the secondary market. This is the Wall Street, which comes after the loan is actually closed. It encompasses not only that, but the interest rates, obviously where a borrower is going to be making their payment long-term. We oversee a majority of the revenue that actually comes into a mortgage company.
Yeah, and your guys' job is vital, for my position, because every day we're talking to borrowers. It's what's my rate? What's my rate? What's my rate? And if you guys aren't doing your thing, setting the rates and also being competitive, which you do, thank you. We can't close deals. So appreciate you. Let's get into rates. You got anything else to add to your secondary manager? You good there?
No, every time I try to explain this to my wife, I just confuse her. So I kind of leave it at anything that has to deal with interest rates or where a borrower is going to make their payment. That's kind of where I'm involved.
I like it. All right. So interest rates, very confusing to some people, right? Or a lot of people. So explain to the people out there what goes into interest rates, like they see on bankrate.com, or hey, rates went up or rates went down. Give us the John Barnes easy interest rate explanation.
So regardless of who the lender is, it starts at one of two places. The interest rate that a borrower receives either starts at what we can get at Wall Street or the amount of return that somebody needs if they're going to hold that loan long term. So when you go to some of the banks and they're doing something, it's called a non-agency loan, one where they're not going to sell this to Fannie Mae, Freddie Mac, or Ginnie Mae. They're looking at what their rate of return is for lending that money out. This is called portfolio lending. It's very bank dependent. It's going to be a very credit union bank, whoever's holding that, whatever they want to see for a return on lending $200,000 to a borrower. When you're looking at the majority, so this is going to be 95% of the production that's done in this industry, it all is based off of either a Fannie Mae, Freddie Mac, or Ginnie Mae price. And again, it's going back to Wall Street. It's what Wall Street's willing to pay to buy this loans that are originated and sold through these channels, through Fannie Mae, Freddie Mac, and Ginnie Mae. So every mortgage lender starts at the same point. We're all dealing with whatever the price is that they'll give us. And that kind of dictates the rate. When I say price, that's how many dollars we're going to make for that interest rate that we're selling. From that point, then we have to build in what our overhead is. So how much it's going to cost to actually close and fund a loan, all of our expenses, what we're going to pay everyone throughout the whole process. And that kind of sets a baseline. Then it comes down to a borrower's profile. What's their credit score? What's their loan to value? Loan to value being how much are they borrowing against what the house is actually worth. And that kind of moves it up or down on that scale. So at the base level of Fannie Mae, Freddie Mac, we put our markups in beyond that of, here's what our overhead is going to be. This is how much we're going to have going out to actually close and fund a loan. Here's how much we're going to pay everyone that's involved in the process. And from that, then it's based on the borrower's credit profile of, here's their credit score. Here's their loan to value being how much they're borrowing versus how much the house is actually worth. And that kind of moves it up or down on the scale. And that sets kind of the interest rates that every mortgage lender in this industry is going to offer. And what makes us all different is based on kind of the experience that we're going to give you guys, the people involved, and your credit profile at the end of the day.
Yeah, and then along to add to that, you mentioned credit profile, loan to value, right? How much money they're putting down on the purchase price, or how much they're borrowing against what it's worth, but also, property types, right? Single family home, condo, duplexes, manufactured homes, all different rates, and along with occupancy type, right? Primary residence, vacation home, investor, a lot of stuff goes into rates, guys. A lot of stuff. It's just not what's my rate today. We got to dig a lot deeper, right, John?
Yep. Very much so. And you see variance. So having a conventional loan versus having an FHA, VA, USDA, you're going to see differences between those as well. And each one has their own different requirement as you get kind of further into it. One has private mortgage insurance, one has mortgage insurance premium. And that factors into, at the end of the day, the overall payment that a borrower is going to make. It's not just the interest rate that factors into it. And I think that's something a lot of borrowers miss in this equation is it's not just your interest rate. Sometimes it's what's going to be best for your scenario. Do you need a higher mortgage insurance premium or no?
Yeah, and that's what we try to convey when people say, "Oh, what's the rates today?" It's like, man, we've got to go deeper than just me saying 4.5. Like I don't know anything about you or what you're trying to buy or anything. So, good explanation. That leads us to the next question: interest rates go up or down every day, right?
Yep.
Sometimes several times a day when we get those dreaded rate increase alert or, lock now, hurry, rates are going to go up. So what makes rates go up or down daily? What causes the volatility either way?
Yeah. So much as I mentioned earlier that it's like the stock market or a bond market. So throughout the day, there's going to be activity and movement that takes place. On Wall Street, there's going to be events that take place here domestically and worldwide that are going to have an impact. And it really boils down to what investors that are investing at the Wall Street level, what they're doing based on the information that's coming out. So there's a lot of things like the jobs report, unemployment. Last year, we had the Brexit situation where Great Britain, United Kingdom was looking at leaving the European Union. That all has an impact here domestically on our mortgage rates. Generally speaking, when you're looking at this, we're looking at the mortgage-backed securities. I know a lot of people look at bond markets and the stock market and how that influences. The interest rates that we actually set are dictated off of mortgage-backed securities. And generally speaking, good news here domestically means that interest rates are going to increase. So when you hear that unemployment is at record lows and jobs report, we added 500,000 jobs in the last quarter, that's typically going to cause interest rates to rise. You're going to see interest rates go from maybe 4.75, 4.875, 5% up to 5.25, 5 3/8. The opposite is also true. When you have bad news, both domestically and also globally, that's going to cause interest rates to go down. Mm-hmm. And the reason for that is on Wall Street, you're going to have investors that are taking their money out of other markets to invest it into our market, which is going to cause, obviously, the price to go down on these securities, and therefore interest rate is going to go down. So situations like this, they're always bad to hear, but Brexit was one of those that caused interest rates to actually decrease for us because investors were pulling their money out of European securities, investing them in ours. Rewinding the clock a long ways, 2011, when we
Wasn't that long ago, man? Wasn't that long ago?
it feels like a really long time ago, but there was the rogue wave, the typhoon, I think it was typhoon that hit Thailand and Japan. That actually kickstarted a huge rally here in the United States for mortgage rates because it was very bad news over there. Investors pulled their money out and put it into our market, and that just kind of added fuel to the flame. So generally speaking, good news is bad news for interest rates. Bad news in terms of the news and jobs reports is good news for interest rates.
Gotcha. So from here on out, I'm wishing for a typhoon to hit somewhere. Gotcha. That's what I got out of that, John.
Sorry to be the bearer of bad news.
Yeah, sorry, Thailand. So good job there. So basically, like, stock market goes up, right? Everyone's feeling good, jamming. Rates are normally going to go.
They're going to increase. Rates are going to get worse.
Right. Stock market's going down, volatile. Everyone's freaking out. Rates are going to
generally improve. We'll see a lowering of interest rates at that point.
Gotcha. Cool. All right. So a lot of questions I get during this time for people watching this is what are rates going to do? Is now the time to buy, et cetera? And so, like, one of the options we have is we can either float their rate, right? We don't lock in the rate at the time of application. We let it float till we feel like it's the best opportunity for them to lock the rate, or we lock the rate in and then for a certain amount of time, up to 30, 45, however many days we got to do to the contract date. My advice has always been, are you okay with this payment? Do you like this rate? Then we lock it today and be done.
That is the best advice.
All right, there you go. So what is your advice, or not advice, but what's the John Barnes, and the good news is it's getting recorded, man. So guard your words here, but your 2019 interest rate outlook. What do you think's coming?
I will say that my crystal ball has been very broken for the last 5 to 6 years. I can say at the end of the year, we typically write a commentary and we send it out within
I love it.
My prediction the last 4 years has been that we walk out of every year, the last 4 years, quoting interest rates at 5% or above consistently. I have been wrong every year. So I will premise it with that prediction because the market there's so much that you can't predict in terms of what's going to happen. My expectation this year is going to be very similar to what 2018 was. We're going to see increases in the interest rates, but I think it's going to be generally pretty balanced. I don't think we're going to see this huge jump that a lot of people have predicted over the past years, like I personally predicted. I would expect at the worst case scenario, you're seeing interest rates that are probably in the mid 5% range to maybe on the upper side. And on the positive side, we're still quoting in the 4% on some of the products and some of the interest rates that are out there. So I would expect to see very similar to last year. We'll probably walk out of this year right around 5%, which is still, again, when people hear this because they were used to hearing, interest rates in the 3s and 4s, 5% is a historically low interest rate.
I was going to ask you, like, that's one thing we also deal with. People got used to 3s and 4s, but there's a couple generations out there where you say 5, right, or 4, or whatever has a 4 or 5 in front of it. They're like, man, my first house was 19. Yep.
Yeah. My parents actually bought their first home at a time where they couldn't get a mortgage. They had to actually assume someone else's mortgage, and it was at 22% interest. Ooh. So we're not that far. It is a long time since that's happened, but you even go back to the 80s and early 90s when we were in the teens, 12 to 15%. Even in the late or early 2000s, we were quoting 8-9%. So you look at this in the big perspective and everyone's hearing 5%, it is not all doom and gloom. Very good interest rate. And the other thing to kind of take into perspective is, how long do you plan on staying here? Is this your forever home, or is this some place that you want to spend 5 to 7 years? You know, it's a great investment investing in a home.
Yeah.
What are your intentions? And in which case, interest rate becomes less sensitive when you're only looking at a 5 to 7 year investment.
Right, right. Well, dude, great stuff. Appreciate you, man. You guys out there watching this, you have any questions, concerns on interest rates, shoot me an email, call me up. My phone number is 239-437-4278. I'll put all my information into the whole video itself. It won't be hard to find, trust me. John Barnes, dude, appreciate you so much, man. Thanks for being with us today.
I appreciate you inviting me. This was nice. Maybe we can do another one. We'll do like a 101 series and then a 102. Then maybe we'll get up to like graduate classes.
Dude, whatever, man. I'm sure I could use it, so I'll take it, man. All right, John, thanks for being with us today. You guys out there, if you're watching this, YouTube, Facebook, LinkedIn, I don't care where it's at, please like the page, subscribe to my channel, say hey, comment, share it with someone you know that's looking to buy a house. This information will help them. So until next time, guys, take care. Thanks again, John.
Thanks, Tim.
Bye, buddy.
Bye.